Singapore's economy fared better than expected in the third quarter, in signs that the city-state's recovery is gaining more traction. But for the full year, the economy is projected to have narrowed to around 1% growth from 0.5 to 1.5%. Our GDP for the 3 months to September expanded 1.1% on year. That is higher than the official advance estimates of 0.7% and it beat market forecasts. On a quarterly basis, the economy grew 1.4%. Again, this beat market estimates and was significantly higher than the 0.1% gain in the second quarter. Now, Singapore's growth was driven mainly by upbeat activity in the construction and services sectors, but the key manufacturing sector still feeling the strain from global headwinds and contracted 4.6% on year. Now, the city-state's economic performance may signal recovery is gaining momentum, but sustaining that performance depends on how well global demand for goods rebounds. Now, Singapore's largest trade partner, China, is contending with sluggish consumption growth and a real estate slump. The conflict in the Middle East also threatening to push up energy and business costs in the coming months. Looking ahead, the Trade and Industry Ministry projects the Singapore economy to grow by 1 to 3% next year. Let's bring in Barnabas Gunn, Acting Group Chief Economist at RHB Singapore for more. Barnabas, let's talk those latest Q3 figures. Economy expanding by 1.1% year on year, faster than the previous quarter. Quarter on quarter, the economy accelerated 1.4%, also faster than the previous quarter. Your initial thoughts?
Hi, good morning, everybody. Yeah, I mean, when I see the numbers, the initial thoughts was that, wow, it's a very good print in the sense that we have been seeing, that the, Q on Q growth has accelerated. It's a better than expected, number. I think overall, it basically fits into our global growth, assumptions whereby we are seeing that the global growth has been, recovering very well in 2023, especially in the second half of this year. Singapore being a trade-reliant economy and a very open, very highly trade with exports going into many parts of the world, we do see that improving trade momentum by various countries, especially ASEAN, would actually be one of the key beneficiaries, for and supports for the Singapore economy in 2024. So I'm not spooked by the number, especially from the manufacturing downside of 4.6% on a year-on-year contraction. I mean, it's not the concern for me simply because of the fact that we are seeing signs of a recovering global, growth story at this juncture.
Well, let's talk about the outlook. So MAS expecting growth for the year to come in at 1 to 3% there. What are your thoughts on that expectation?
So I think essentially when we see that the growth, it's still a positive print, and this basically suggests one key message that I hear from policymakers. Really, it's that global growth and Singapore growth will likely accelerate. Now that the growth is basically estimated at around 1% for 2023, and will actually accelerate to 1 to 3% next year. It basically does fit into this understanding that Singapore will see a rosier 2024. And why would it be? In our view, really, it's because of two key factors. I think first and foremost, the US economy still remains quite resilient year to date, even to in this year. And this basically suggests that if it continues, the global growth as well as global trade will continue to be supported by the US economy. But more importantly and pertinently, really is the fact that China's economy is likely to also accelerate into 2024. Now there's still risk of the property sector and risk of corporate defaults in China. But what we are seeing is that early signs of recovery is seen in China. We are seeing high frequency numbers in China improving as we speak. And this basically suggests that if this continues, we are going to see another leg of a recovery, another driver for global growth, and that's China for next year.
Many are saying that, the effects of the monetary policy tightening, especially in the US and Eurozone, we will only start to see the effects next year. Is that not a concern, a big enough concern for you? Because you seem pretty optimistic on demand outlook for Singapore, especially from these countries.
Mm. Yeah, that's a very, very good observation. But the thing is that what we do see is that the lag effect, more so, or more so the period of which the global economy digests higher interest rates, the tightening interest rates by both US and Eurozone. Well, there are some schools of thought. What we do believe is that the negative impact, so to speak, from the tightening effect, it's less than what people do assume for. I don't think that it will be felt next year. I mean, more so, it will be felt next year. But I think a good part of the impact is really seen, really as we speak right now. But the point is that we also do see that if the path of inflation for the US trends towards 2% into the next year, especially in the fourth quarter of next year, this also basically suggests that the tightening cycle will no longer be tightening and will maybe ease into the fourth quarter of next year. And this basically suggests that global investors and consumption patterns will continue to improve because of slightly accommodative monetary policies for the next year.
Is the worst over then for the Singapore economy, or is it too soon to say?
I think the worst is over a while back, if you ask me. We are really seeing, that the high frequency numbers and the latest numbers that we see, really, it's the manufacturing and trade numbers. I know it is in contraction territories on a year-on-year perspective, but if we look at it in another light, from a momentum perspective, which is on a month-on-month seasonally adjusted basis, for high frequency numbers, and this is what will make or break the Singapore economy because we are a trade-reliant economy. So we have to see trade and manufacturing numbers in very close detail to basically decipher the strength of the recovery in Singapore. So now that we have seen that the momentum of these numbers have been improving despite the year-on-year contractions, and the year-on-year contractions have also decelerated. So this basically suggests that the high frequency numbers, these externally facing sectors are already seeing some light at the end of the tunnel as we speak right now.
Well, thanks for joining us this morning to break down those latest figures. Barnabas Gande, acting Group Chief Economist at RHB Singapore.